Hey, welcome to the exchange. Let's take a look at Redbox. Yes, that Redbox, the one you haven't used in years. It's up 300% in the past 2.5 weeks. So I'm breaking this video really in two parts. So the first part will be basically meme stock, kind of short squeeze analysis, what potentially is possible with short squeeze. Second half I want to do is more fundamental analysis, what's actually going on behind the scenes, what their financials actually look like, how much can it actually grow potentially this year and or next year. So this is the Redbox chart right here. So this is the 1 month chart. As you can see, it's really mid-April started spiking up pretty heavily, but really late April really started going parabolic right there. Broke $10. Right now it's about $6, $7 in that range right there. See the volumes, I mean, absolutely massive, but we go to a 3 month chart for the comparison. So you see the volumes down below. I mean, the volume bars are almost nothing. It was trading a few thousand shares a day at most. Pretty steady around that $2, $2.50 range in there, give or take. But again, you see the last month or so, I mean, it's just been absolutely nuts. I mean, crazy ride for Redbox. So let's take a look at short interest real fast. So this is Ortex. Basically, it's a stock data platform. The only thing to notice here is estimated short interest or interest percentage of free float. Right now, it's at 53.69%, which that is absurdly high. Anything north of 20% is a high short interest overall. I mean, 53.69 is just, it's nuts high. It's crazy, absolutely. GameStop, for example, back in January 2021, I believe when it started running really hard, it was at 43% or so. So I mean, this is even above that, and this is one of the things where, hey, all of a sudden they have that small free float already. Short interest, basically, short interest rate or short interest overall drops that down even further. So I mean, right now it's basically trading like it has 4 million shares overall for the entire company right now, which is pretty crazy. Another thing to look at here is cost to borrow. So cost to borrow is basically the interest rate, the APR short sellers pay to actually borrow those shares. Right now it's at 323% annualized. So basically, if you're a short seller coming on board right now, you need a stock to crash for the next 2-3 months at most in order to make any kind of profit at all. Because I mean, at these current prices, if it maintains the current level it's at right now, I mean, you're gonna get absolutely killed as a short seller with these actual cost of borrow fees. Which I mean, again, the higher the stock goes, the more volatile it gets. I mean, these fees are gonna go up higher and higher and higher, and this can change daily too, and you have to pay it. So I mean, it's gonna be pretty crazy. And just kind of see where this goes in the next 2, 3, 4 weeks, if not more. Let's get some of the more fundamental analysis. That was more of the short squeeze kind of meme stock analysis. Look at actual fundamentals right here. So I pulled up their actual, from the SEC, their actual 10K, which they filed a couple weeks ago. So you see on the right here, this is December 2019. The far left, December 2021. Usually I do it reverse, but this isn't this way. The way it downloaded is the reverse, the way I normally do it. So looking at revenues overall, so 858 million in 2019. I mean, 288 million in 2021. So already you can see, hey, revenues on a strong decline. You think, hey, COVID, stay at home, like entertainment stocks, like Netflix and everything else too. You thought Redbox would do okay. I mean, it's absolutely shocked me just how bad it actually did. Also, everything you see in blue here, I actually did myself. I basically added those lines in. I basically did a dollar for dollar comparison of those product costs versus a dollar of revenue. So product cost is roughly about 40% or 40 cents for every dollar revenue it brings in, which it's been pretty stable over time, which makes sense. Well, again, it's not too high, not too low. It's about what I would have expected. Operating costs, I mean, look at actual per dollar basis. So back in 2019, it was 28 cents per dollar of revenue. Back in 2021, just recently, it's 46 cents per dollar of revenue, which is extremely high. And that's a problem where it's, like I mentioned earlier, or mentioned here, is reverse economies of scale. Basically, as it gets smaller and smaller, I mean, those operating costs also skyrocket on a per dollar, per unit basis. I mean, it's gonna get pretty crazy. Same thing with G&A, which is general administrative. So dollar for dollar comparison, back in 2019, it was 8 cents. I mean, very respectable, no problem there. I mean, 2021, it was 21 cents. So you see right here, I mean, these costs absolutely eat up their revenue, and then all of a sudden, that's why they're very negative after everything else. So this is the same data pool. I just pulled up their balance sheet real fast. This is as of December 31st, 2021. I mean, they had 18 million in cash. But really what I noticed here was, hey, total current liabilities, 124 million. Total long-term debt, 287 million. I mean, so they are a very indebted company. You think about, hey, cash flow negative, shrinking overall economics, trying to, the streaming platform, everything else too. Also, like with the hardware and the software side. I mean, they're in a very tough spot. And like, it's one of the things where I looked at this and it's like, hey, there's really no way out potentially, but maybe bankruptcy potentially. I mean, it's going to be a very tough uphill climb for Redbox if they make it out at all potentially. So I went to the SEC, pulled up some of their documents. This is a form 12B-25, which all it means is basically that's a late filing report saying, hey, they're not going to be able to file their annual report on time, etc. So basically what it's saying here is the actual narrative. So as previously disclosed, company's business during 2021 was negatively impacted by the ongoing pandemic, and coupled with higher marketing and content expenditures, the company increased costs during the fourth quarter of 2021 were not offset by the increase in revenues. On January 28, 2022, the company borrowed the remaining availability under its revolving credit facility, which basically a revolver, all it means is like a corporate credit card. Basically, what they did is they maxed it out, which typically for any company or even person in general, maxing out credit cards is very, very bad. Usually a sign of distress, which they're in distress right now. So they're taking active steps to basically hoard cash, so to decrease monthly costs, delay capital expenditures, and increase revenues. So this next little line here, the company's been exploring a number of potential strategic alternatives with respect to the company's corporate or capital structure and seeking financing to fund operations and one-time restructuring costs. So what they're trying to do is trying to raise debt and repivot the company potentially. Basically what happened was, it was saying down here, they couldn't file a timely 10K because all these changes, looking for capital, really trying to save the company in the last month or so. I mean, they just couldn't file it because, I mean, things are changing so fast where as soon as they filed it, it would be basically, stagnant information, it'd be dead information overall. Again, this is not surprising given where they're at right now, but this shows, hey, they are very, very distressed as a company overall. And in literally the last month or so, I mean, it could have been, hey, lights out potentially for them, for Redbox in general. This is their Form 8K. What happens here is basically it's running down the actual financials of their financing deal. So they're able to raise $50 million. So, I mean, they have runway for, and give their cash burn rate probably an extra like 6 to 9 months potentially, if not more. They will need to raise cash either later this year or beginning of next year if they're still around by that point too. But I mean, for at least short-term runway, they have the cash. I mean, they gave up a lot of warrants. They gave up a lot of convertible debt potentially to these various shareholders led by Apollo Management, etc. But I mean, short-term, I mean, they're okay. They're not going to go out of business next, basically the summer time frame. But again, we'll see though. But at least in short-term, they're looking pretty good. So this is from their 10K. So on April 1st, 2022, the company announced a reduction in the force of 150 employees completed on March 29, 2022. So they're really dropping the personnel, dropping those variable expenses as far down as they possibly can go. And this will reduce our annual operating cost by $13.1 million or so. I mean, so they're making that, hey, heavy pivot. They're trying to get very, very cash tight. They're really to survive the next few months potentially. So very last point, this is from their auditing firm, which is Grant Thornton. So they actually received a going concern, which a going concern, all it means in the next 12 months or less for any company, it means that, hey, they may not survive based on liquidity, resources, market volatility, etc. It's saying, hey, it's warning shareholders or investors, hey, this company is in financial distress. They're going to have trouble. So basically, if it blows up next 12 months or less, hey, do not be surprised by that. So all it's really saying here is, hey, the company incurred a net loss of $112.8 million during the year ended December 31st, 2021. And as of that date, the company had $18.5 million on cash on hand, a working capital deficiency of $59.3 million, which all that means is, hey, based on the actual cash of the business they actually need to operate, based on their accounts receivables, accounts payables, paying their employees, etc., they're short on their budget by about $59 million across the board. So what we're saying there is, hey, they had to raise the cash, and that's really why I saw the Apollo Management Group raise about $50 million. Between the actual $50 million raise and the workforce cuts, some of the variable cost cuts, they're actually right about where they should be for the actual fiscal year for this year. But next year, I mean, it'll be a whole new ballgame. But they actually need to probably raise more cash potentially. And I mean, who knows? The economy at that point could be in recession. Who knows what could happen with that? But at least for right now, this year itself, calendar year wise, they should be okay. Hey, but that's Redbox overall. Kind of really the meme stock side and the actual fundamental side. I mean, the fundamentals are ugly. I mean, there's really no denying that. It's an ugly uphill climb if they're going to recover at all. I'd say more than likely they're spiraling the drain potentially. But again, I could be totally wrong too. Look at the actual meme stock side. I mean, it's the data is there. I mean, you look at like a short squeeze overall, the data is definitely there. Now, one thing to notice too versus a GameStop, for example, they don't have options trading because, I mean, the volume was so low that you couldn't price options on that kind of low volume. So they applied volatility on options. You just couldn't calculate it because there wasn't enough data. If it stays, elevated trading levels, elevated trading volume for a next month or so, I mean, there might be options coming on the table there. But again, right now, that's one thing you don't see like you have with GameStop with the gamma squeeze and everything else too. But that's definitely a difference right there. But I mean, short term possibility of a squeeze. Long term, I mean, this company's gonna be in much trouble overall. But that's Redbox overall. Hey, be sure to sub, like, comment down below, and that's the exchange.